Hey everyone, welcome back to Corporate Dakota. Today we are diving into a new report, and by report I mean corporate roller coaster, specifically Redwire Corporation's latest filing. It's got everything, stock offerings, risk factors, and a whole lot of financial jargon that we'll decode together. Think of it as turning a complicated space mission into a simple walk on the moon. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can share your thoughts. So on June 16, 2025, Redwire Corporation, which is a company incorporated in Delaware, filed this report. The main reason they filed is to announce a major event, a common stock offering. This basically means they made a big deal, a serious agreement to sell shares of their company. More specifically, Redwire entered into an agreement with a group of big name investment firms like JP Morgan and Bank of America to offer and sell shares of their stock. Think of these firms as the sales team for Redwire's stock. They're offering 15,525,000 shares of what's called common stock for around $260 million. This is like putting a bunch of slices of their company up for sale to raise money. These shares are being offered under what is referred to as a registration statement. Basically, this means they did all the paperwork with the Securities and Exchange Commission, also known as the SEC, to make the sale legal, giving potential investors a chance to review the information beforehand. The SEC already approved the registration in September 2023, so they got the go-ahead to offer these shares. Here's a little bonus: the investment firms handling the deal, called Underwriters Got a Deal. They have the option to buy an extra 2,328,750 shares. It's a kind of bulk discount. They have a 30-day buy more coupon for more shares at the same price. Good news, it says here, they did not chicken out. Just 2 days later, on June 18, 2025, the company finalized the sale, meaning they got the money and investors got the shares. To keep everything above board, Redwire got an opinion from a law firm, Holland and Knight LL. These lawyers basically checked that selling the stock was legal, meaning the paperwork and the sale itself were all done by the book. Here is where it gets important. Redwire's plans about what to do with all this new cash. This is based on an agreement that states how they will be using whatever they made from the stock sale. They have existing agreements with Bain, Industrial Partners, and others, which might influence some of the decisions. The first $40 million they collect after taking away costs will go directly into Redwire's bank account for general use, like paying bills or investing in growth. It's like pocketing the initial profit to keep the business running smoothly. Things get interesting. They will take 25% of the money, or $50 million, based on what they have lying around, to buy back some stock from Bain. Bain can choose if they want to sell those shares. Buying back shares can help increase the value of the stock that's out there. Finally, Redwire plans to use the rest of the cash to pay off debt from when they bought Edge Autonomy Intermediate Holdings LLC. This is like paying back a loan so they can own the company outright without owing money. To make sure everyone knows what's going on, Redwire filed additional paperwork with the SEC on June 17, 2025. Consider it like making the details of the sale official and public, so all investors and interested parties can access the information. Now, let's review an important update on risk factors. You know how companies have to tell you all the stuff that could go wrong? That's what we're talking about. Redwire included additional risk factors from Edge Autonomy, the company they acquired, to the ones already listed in their annual report that they filed in March. So, what kind of risks we are talking about here? This is listed as Exhibit 99.1, so let's dial in a little bit further. Before we dive into these risks, you need to keep in mind what it says here: forward-looking statements, basically saying that what they expect or think will happen with the company can be affected significantly and change for many reasons outside of their control. Now, the risks, many of the biggest are tied with broader economic issues such as a possible recession, reduced spending, inflation, rising interests, challenges within the supply chains, manpower, etc. But wait, there is more. Redwire doesn't have a long history and it has been losing money. Add to that the newness of the drone industry, and that Edge Autonomy is in the same situation. Integrating Edge Autonomy or any other company is not easy. It needs to fit together and create new value in order to work. Also, the company might not get the financial and business boost they were hoping for. A big risk that we see repeated in a lot of filings with companies that are developing many things at once is that they might not be able to develop any specific thing, or they're refining that thing to make it better. The space and drone industries are competitive, so they might get out-competed by current players or new players, Redwire's optimism about its future might be unrealistic, so things might no go according to plan, which is very common for new industries. If there is a negative perception or press over the company, for example a drone malfunction, then the company can suffer. Performance issues with products specifically related to space or outside environment is a risk that any company is likely to face with challenges in the space. The markets for space services and drones are new and unproven. Basically, it could blow up if people realize this has no practical applications, but it can also go to the moon. They might not be able to complete all the orders they have, which would cut the profit that Wall Street expects. Redwire depends on government contracts, which are not always secure. These things can always be cancelled any time. Redwire is heavily regulated. These regulations can cause problems if they do any business internationally. Redwire may need more money, which they may not be able to get at all. It's also possible that it might only be valuable on terms that are unfavorable to them. The stocks that we talked about might not work as much as they expect. By having more shares, they might be worth slightly less. This is called dilution. AE Industrial Partners and Bain have a lot of control over Redwire, which could create all sorts of imbalances. The specifics of preferred stock, a type of stock, might prevent or delay Redwire from being acquired. Holders of preferred stock have advantages over those who hold regular stock. These can cause imbalances that impact future growth. The price of Redwire stock can change a lot. Rapid or unexpected changes can be bad. People betting against Redwire through actions such as short selling, which involves borrowing the company's share and then selling them out in the market, expecting for the price to drop and getting profit. Short selling might influence and affect the value of company's stock. Redwire might not be able to accurately report its financial results, stemming from the weakness they identified inside of financial reporting, such as edge autonomy. The combination of Redwire and edge autonomy have the potential to disrupt any plans due integration issues. The company's ability to get enough money to keep the company going is important, of course. In case of failing to secure additional funds, can jeopardize its future success. If Redwire takes on more debt to run the business, it can limit its options, reducing flexibility to take advantage on new opportunities. A large portion of edge autonomy sales depends on sales to Ukraine. If the war ends, there might be a problem. This is called concentration risk. Finally, this section lists all the documents attached to the report, like the agreement with the underwriter's legal opinions and more details about the risks. So summing it all up, Redwire is raising money through a stock sale to fund operations, pay off debt, and possibly buy back shares. However, they face significant risks, including economic issues, market competition, and challenges with integrating acquisitions. Their future depends on managing these risks and successfully growing in the competitive space. From my vantage point, Redwire displays a mix of high-risk, high-reward characteristics. Their strategic move to raise capital and diminish debt positions them for possible expansion. The company's reliance on government contracts introduces a layer of unpredictability due to changes in state budgets and political agendas. However, they need to carefully manage the financial reporting systems of acquired companies to ensure trust in their data as they continue developing their proprietary tech and compete in the in-space and drone industries. Alright, that was our breakdown of Redwire's latest filing. What's your take on these numbers and what they mean for the company's future? Drop your thoughts in the comments. If you found this analysis valuable, hitting that like button really helps, and subscribe for more corporate deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.